The highest paid people in the room are quietly being replaced, and most investors are missing it. This isn't about factory workers, it's about lawyers, analysts, and radiologists. And if you know which sectors are shedding those salaries, you know exactly where to move your money. Let's map the disruption and build a portfolio around it. White-collar AI displacement is accelerating faster than most headlines admit. Industry data suggests knowledge work tasks, research, drafting, analysis are being automated at scale. Goldman Sachs reportedly estimated AI could affect hundreds of millions of jobs globally. That's not a tech story, that's a capital allocation story. So let's start with the sector taking the hardest hit first: legal services. Junior lawyers spend most of their time on document review, contract drafting, and due diligence. AI tools are now doing that work in minutes, reportedly at a fraction of the billable cost. Big law firms are already quietly trimming associate headcount. That means less revenue for commercial real estate in legal districts, and that's a red flag for certain REITs. Next up, financial services, specifically research analysts and junior bankers. Equity research, earnings summaries, and pitch decks are increasingly AI-generated. Major banks have reportedly begun piloting AI tools that do the work of entire analyst teams. This compresses headcount, but it expands margins for the banks that adopt fastest. We'll come back to which financial stocks benefit. Hold that thought. Healthcare is the third major sector, and this one surprises most people. Radiology, pathology, and diagnostic reading are being augmented and in some cases replaced by AI models. These are six-figure roles, and the disruption is already underway in pilot programs globally. But here's the wealth-building twist. Disruption in healthcare creates massive winners too. The companies building and selling these AI diagnostic tools are seeing explosive demand. Now, let's talk about the fourth sector most investors overlook: accounting and tax preparation. AI is already handling bookkeeping, tax filing, and audit prep for small and mid-sized businesses. This puts pressure on mid-tier accounting firms and the commercial office space they occupy. Okay, we're about halfway through, and here's the critical reframe. Every sector losing jobs to AI is simultaneously funding the companies that build AI. The disruption and the opportunity live in the same ecosystem. You just have to be on the right side of it. So where does the smart money actually go? Let's build the framework. Layer 1. Direct AI infrastructure, the picks and shovels play. Semiconductor companies supplying the chips that power AI models have seen demand surge, reportedly outpacing supply. Cloud infrastructure providers, the companies renting the compute power, are the landlords of the AI economy. These aren't speculative bets, they're the plumbing every AI application runs through. Layer 2. The financial institutions that adopt AI fastest will compress costs and widen moats. Think about it. If a bank can do the work of 100 analysts with 10, margins expand dramatically. Large cap banks and asset managers investing heavily in AI tooling are worth watching closely. Layer 3. Healthcare technology, specifically AI diagnostics and drug discovery platforms. AI is reportedly cutting drug discovery timelines from years to months in some cases. Companies at that intersection of biotech and AI are early stage but potentially high reward. Now, what should you be reducing exposure to? Class A office real estate in legal, financial, and corporate districts faces structural headwinds. If fewer white-collar workers show up, demand for that square footage drops, and so do valuations. Certain REITs heavily weighted toward office space may be structurally challenged going forward. Mid-tier professional services firms, the ones too small to build AI and too big to pivot fast, are also at risk. Now let's talk about the asset class most people forget when tech disruption accelerates: commodities. AI data centers consume enormous amounts of electricity and require massive physical infrastructure. Copper, energy infrastructure, and cooling technology are all downstream beneficiaries. Energy stocks, particularly those supplying data center power, are quietly becoming AI plays. This is the kind of second-order thinking that separates wealth builders from passive observers. Let's also address the elephant in the room. What about your own career and human capital? Your earning power is your largest asset, and it needs to be in a role AI augments, not replaces. Roles that direct AI, interpret AI output, or manage AI risk are growing, not shrinking. That's a portfolio decision too. Investing in skills is capital allocation. All right, let's pull the full framework together before we wrap. Overweight: AI infrastructure, chips, cloud, and the picks and shovels layer. Overweight: financial institutions and healthcare tech companies leading AI adoption. Consider energy and commodity plays tied to data center infrastructure demand. Reduce or monitor office-heavy REITs and mid-tier professional services firms, and always size positions according to your own risk tolerance and time horizon. If you found this framework useful, subscribe. We map disruption into portfolio strategy every week. Hit the bell so you don't miss the next one. The next wave of displacement is already forming. Quick disclaimer, everything here is for educational purposes only, not personalized financial advice. Always do your own research and consult a qualified advisor before making investment decisions. The AI disruption is already priced into some assets and completely missed in others. The investors who map the disruption first are the ones who capture the upside. See you in the next one.